The U.S. Federal Reserve has kept interest rates unchanged for a second straight meeting, citing elevated uncertainty from the ongoing Middle East conflict. Policymakers still project one rate cut this year, despite rising oil prices and weaker job data clouding the economic outlook. Our Seung-jae has more.
The U.S. Federal Reserve has held its benchmark interest rate steady for a second straight meeting, maintaining its projection of one rate cut this year as uncertainty grows over the economic fallout from the ongoing U.S. Israeli war against Iran. At its two-day Federal Open Market Committee meeting on Wednesday, the central bank decided to keep the federal funds rate unchanged in the 3.5 to 3.75% range.
Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals.
The move leaves the interest rate gap between South Korea and the United States at up to 1.25 percentage points. The decision also comes as policymakers face a difficult balancing act. Rising global oil prices are fueling concerns about renewed inflationary pressure, while a weaker U.S. labor market adds to worries about slowing growth. The latest employment report showed the economy lost 92,000 jobs last month. Despite the uncertainty, the Fed's updated median forecast still points to the federal funds rate being lowered to around 3.4% by the end of the year, signaling the possibility of a single quarter percentage point cut in 2026, unchanged from its December outlook. In its statement, the central bank warned that uncertainty about the economic outlook remains elevated, particularly due to developments in the Middle East. Officials said the implications of the conflict for the U.S. economy are unclear, but stressed they are closely monitoring risks to both sides of the Fed's dual mandate of achieving maximum employment and stable inflation at around 2%. Fed Chair Jerome Powell also stressed that higher energy prices are likely to push overall inflation higher in the near term. However, he cautioned that it is still too early to determine how lasting or severe the impact will be. When asked whether the Fed expects the current oil shock to be temporary, Powell said no one can be certain. He noted the economic effects could turn out to be much smaller or significantly larger than anticipated, underscoring the high level of uncertainty facing policymakers. Seung-jae, ArirangNews.